Welcome to this Opalesque virtual manager visit. Today, we're visiting San Francisco to meet with Honest Capital, a concentrated, long-term, long-biased investor in high-quality North American small and mid-cap equities. We will be meeting with portfolio manager Sean Badlani, who founded the firm last year. His early returns have been amazing, with an 88.4 return net of fees in 2020 and additional strong returns in 2021 year to date. Now, Sean, can you tell us about your background, please?
Hey, Matthias. Thanks for having me. I'm excited to be here. So, in terms of my background, I grew up in Pittsburgh, Pennsylvania. I went to Harvard undergrad, and my first job out of college was in investment banking at Blackstone in New York. And one of the things that ended up shaping my career happened to be when I was working there, which was my team got hired as advisors by Bill Ackman at Pershing Square. This was back in 2004, before he was really a well-known person. And I got to work really closely with him and his team on some of the earliest activist investments that they made, specifically in Wendy's and McDonald's. And I just learned so much from observing him and working with his team, really about just the mentality of when you buy a stock, really thinking like a business owner, like you're owning that entire company is the mentality that you should have. And also just the idea of doing a ton of diligence on your investments, gaining a lot of conviction, and then running a really concentrated portfolio of only those investments where you have a lot of conviction. That approach really resonated with me and really stuck with me. So after that, I moved over to Canyon Capital in LA, which is more of a credit focused fund. And my biggest takeaways from that experience were just in credit, you really get trained to focus on downside protection and just thinking through what can go wrong in each investment and really focusing on trying to minimize your mistakes and minimizing those situations where you lose money. So that has stuck with me throughout my career. And also, I think just learning how credit markets work, understanding companies' capital structures, understanding how to read credit agreements and bond indentures were also really helpful skills that I feel like can come in handy even in the equity markets, especially in times of distress like March of 2020. So after my time at Canyon, I went back to Harvard for business school, graduated with my MBA in 2010. And it was an amazing coincidence for me, actually, that right when I was coming out of business school, one of the first analysts at Pershing Square, a guy named Mick McGuire, was leaving to start his own fund, Marcato. And he was doing it in San Francisco. So I got to join Mick as the first employee at Marcato, got to help him build out the rest of the team, build out the firm, build out the portfolio from day one, which was a really cool experience. And his thesis in starting Marcato was to take the Pershing Square approach, but reapply it to the small and mid cap universe where there's just so much more opportunity because there's more inefficiently priced stocks, because there's less sell side coverage in those names, and they're just kind of too small to move the needle for bigger funds. And also from a shareholder engagement or activist perspective, there's just a lot more opportunity because you can find companies that haven't already been pitched the kind of ideas that you would bring to them from investment bankers or other shareholders or sell side analysts. And it's just much easier to gain influence in those kinds of companies. So we had a great experience at Marcato. We basically had great returns in our early years, grew the fund from zero to $3 billion of AUM at its peak. And a highlight for me was in 2015, we launched a second product, which was more of a dedicated small cap fund. And I was promoted to co-portfolio manager on that fund. It was called the Encore Fund. And so for 4 years, from 2015 to 2019, I got portfolio management experience on that Marcato small cap Encore Fund. and built a good track record, and just found that I really enjoyed finding those smaller, under the radar companies that were just a little too small at the moment to be on the radar of bigger funds. But, I felt if you put in the research, you really could identify really great companies that were on their way to becoming much bigger companies before the broader market found out about them. So that experience led me to want to start my own fund, which I did in early 2020, Honest Capital. And the strategy is very similar to what I was doing at that Marcato small cap fund. It's just a highly concentrated 10 stock portfolio. I take a multi-year investment horizon on each stock that I buy, and I'm focused on North American small and mid caps. So just looking for really high quality companies that are a bit under the radar or too small to move the needle for bigger funds. And the early performance has been really strong. I was up 88% net of fees in 2020, which was the first year of the fund. And in the first half of 2021, I'm almost up another 20% net of fees. So it's been a really good start.
Well, congrats on the great early performance, and thanks for walking through your background. It is really helpful to hear about how your different experiences have informed the way you think about investing today. Now, can you tell us more about your strategy? Well, as you know, there are a lot of value funds out there. What is actually special about your strategy, and how are you doing things differently than your peers?
Sure. I think there are a few things that allow me to generate unique returns. The first being concentration. And that's just, again, being highly selective, only owning a few securities at a time allows really in-depth private equity style diligence on each investment. And again, I tend to hold 10 stocks on at a time, sometimes fewer than that. The other thing would be a North American small and mid cap focus. Again, looking at companies that are under the radar or too small to move the needle for larger funds is a rich opportunity set with less competition. Another really important thing is just the long time horizon. That really allows me to take advantage of the short-termism of so many other market participants by underwriting at least a 2 to 3 year investment horizon. Another factor would be the value orientation. Again, going back to my credit background, just being really price sensitive, having a rigorous focus on downside protection, and attempting to purchase high quality companies only when they're available at discounted valuations. And then the last thing I would say is shareholder engagement or activism. I have a decade plus of experience doing that at Marcato, and it's going to be certainly not all my investments, but a minority of investments. I do think I can help create value through engaging with the board or management team, and kind of serving as our own catalyst to drive uncorrelated returns.
That's a helpful overview. Can you think of other benefits that this strategy offers to investors?
Sure. Yeah, there are definitely other things that LPs like about the strategy. It's really liquid and it's really easy to value since I only own a handful of publicly traded stocks. It's also really transparent. I tend to tell my LPs everything that I own. I disseminate my thesis on the companies and why I like them, and so people can follow along at home, which they really appreciate. And then it's also very tax efficient, because I take this long-term approach. It lends itself to tax efficiency, and I'm a huge LP in my own fund, and so I don't like paying taxes, and so I do everything within reason that I can to minimize taxes, and I have a lot of family office investors who really appreciate that as well.
Now, Sean, what do you actually mean when you talk about high quality businesses? And how do you buy high quality companies at a discount? Well, as you know, the small and mid cap universe is really thousands of companies. So can you talk to us more about what you're looking for and how do you find it? Well, in other words, what's your screening process?
So I am looking for high quality companies. And to me, a high quality company is a company with some kind of competitive advantage or moat, where it's doing something that cannot easily be replicated by competitors, which allows the company to earn a high return on capital for a prolonged period of time. And eventually that's going to show up in the financials as stable, predictable free cash flow, high margins, low capex, lots of free cash flow generation. And it's easy to say you want to buy a high quality company at an attractive price, but it's very hard to do that in practice. So how do you do it? Well, I have a few things that I think are working in my favor. I only own 10 stocks at a time. I try to own them for 3 years or so on average. So if you run that math, it implies that I'm really only looking for three new stocks to buy each year, roughly on average. And by focusing on small and mid caps where there's less competition, I always feel like a few times a year I can get an opportunity to buy a really high quality company at a really attractive price. And another thing that helps me is the universe I traffic in of these small and mid caps is exactly the same universe I was looking at when I was at Marcato for the past decade. And so over that time, there's several hundred companies that I did work on and have a good understanding of their industry and their business model. So I have a watch list of a lot of companies I've looked at. And again, the good thing about being so selective is that I have really high hurdle rates for new investments. Typically I'm looking for at least a 25% IRR in my underwriting when I'm buying a new stock. And so if I have a watch list of, say, 300 companies that I've looked at over the past decade, it's pretty easy to look across that list and say at any given time, 95% of those are, not at prices that are obviously going to offer me the kind of IRR that I'm looking for. But at any moment in time, there's usually a handful that look attractively priced. And that's one way I fill my top of the funnel for what I should spend time on. Another way that you can buy high quality companies at attractive prices is around corporate events, special situations. And so within small and mid caps, I'm always looking at special situations, whether that be spin-offs, mergers, reorgs, recap, post-reorg type situations. I'm always looking at those kinds of things. And sometimes the event can be something softer like a management change, a strategy change, especially if a company is kind of transforming its business model from capital intensive to capital light. A lot of times, that gets missed by the market while it's happening. And that's a fertile hunting ground for the kinds of things I look for. And, besides that, there are other patterns that I've had success with over time that I'd say, one of those is sum of the parts, for example. I've had a lot of success over time with companies that maybe have two different business segments, especially if those segments have different economic characteristics. Like maybe a company has one business line that's very capital intensive or one business line that's capital light. Or a company has one business line that's growing really fast and another business line that's not growing or not growing as fast. I found in those kinds of situations, the market almost systematically misses or underprices those kinds of companies, because if other people are screening based on consolidated financial statements, they would miss the deeper picture of what's really going on one level lower. So that's a pattern that I've had a lot of success with through my research. Another one would just be hidden asset value, a company where there's assets, whether it be real estate or even working capital, where there's kind of trapped asset value and the market is just not giving credit in the stock price. So I found in those kinds of situations, if you're willing to buy the stock and be patient, eventually the market does figure it out and, you can make a really good return. That's related to the other thing I would say where I've had so much success over time is just having a long time horizon, and that allows you to buy good companies when they're facing temporary headwinds. And, I feel like those are the situations where I've had the most success in my career, is just situations where everybody knows it's a good company. But so many people in the public markets, and it's not their fault, it's because of the seats that they sit in, they have to worry about monthly vol or quarterly vol. And so if you can actually take a multi-year approach, you can take advantage of those situations where, look, everybody knows this is a good company, but so many people are just afraid to buy it because, they're worried that this is going to be a light quarter, or, the company is facing some headwinds for the next quarter or next 2 quarters. And those are situations where I love, where, you can go in, this is a good company, over 2 or 3 years, whatever temporary headwinds it's facing, will get resolved, and, the market will revalue it higher again. And, the flip side of that is sometimes you're going to be too early and you have to be willing to endure volatility. But if you can do that and you can still see your way to a really attractive IRR over the entirety of the time horizon, I feel like I can always find those kinds of situations and have a lot of success with those kinds of situations. I mean, some people call it time arbitrage, but whatever you want to call it, that is a huge part of what I do.
Well, that's fascinating. I also have to ask you now about shareholder activism, because a lot of your background is really focused on that, but you haven't mentioned it yet today. Now, are you doing shareholder activism today, right? And what does this term precisely mean to you? Maybe can you give us some examples also?
Well, in terms of shareholder activism, I think I'll definitely do it less than we did at Marcato. Now that I've been running Honest Capital for a year and a half, I've just found that if I'm only trying to own 10 stocks, I'm only looking for a few new stocks a year, like I said, I always feel like I can find a few that are going to offer a great return and don't require any activism. But I do think it can make sense in certain situations if I find a company that I like anyway, and I have 1 or 2 ideas for ways that they can create more value, and I can engage with them constructively, then I'm willing to do it. And, for me, after having been through many activist campaigns, I've just found that if I can work constructively with the board and management team, stay behind the scenes, and convince them in a friendly manner through logic and analysis, that these ideas will create value, and then let them take the credit for it, that just works better for everybody, in those situations. And I've also found with small and mid caps, what we talk about activism, but it can really be more shareholder engagement, and it can be even a little bit softer. I've had a lot of success actually advising companies on investor communication, almost like an outsourced IR consultant, if you will. Because usually if I'm buying a stock, almost by definition, I feel like it's not fully understood or appreciated by the investment community. And so by giving them feedback on ways to communicate better with the street about the quality of their business, I found that can be a really successful way to add value in some of these companies. So I have a great example like this from my portfolio today. The company is called Chatham Lodging Trust. The ticker is CLDT. And it's a hotel company that owns 40 hotels across the country. In the pandemic, the stock went from $20 a share to $5 a share. And, because of my long time horizon, when the pandemic happened, I was looking for travel related stocks because I figured, look, I didn't know when the virus was going to go away, but I figured over the course of 3 years, it was likely to go away. And over the entirety of that time frame, you could get a really attractive return if you were willing to just buy and hold. And so I was looking at travel related stocks. What drew me to this company was the balance sheet. Again, going back to my credit background, I was able to analyze the balance sheet. And even though it optically looked like Chatham Lodging Trust had a lot of debt, as I read through all the credit documents, it was crystal clear to me that They didn't have any near-term maturities. They didn't have any covenant issues. And they had plenty of liquidity to make it through several years of very low revenue levels and be fine. One thing that was nice about the company, their hotels are extended stay hotels and limited service hotels. So there's only a few employees per property. So they were never burning much cash, even in the worst part of the pandemic when revenue was zero. They were barely burning any cash. So it was obvious to me that they would be able to make it through. And the way their debt was structured was also very favorable. Almost all the debt was property level mortgages on the individual hotels, and the corporate entity had very little debt. So that was a nice way to have the debt structured, when you're going through a pandemic. And so that attracted me to the stock. And the purchase price I was paying was roughly a quarter of, what the company had paid over time for all of the different hotels that it owned. So again, I felt like there was huge asset protection, huge upside over a few year time frame. And so and it was only a $250 million market cap. So it was, exactly the kind of thing I like to look at. And, I'm pretty sure not a lot of other people really paying attention to the company. So it turned out to be a really great investment for me. But the reason I brought it up was kind of the constructive engagement that I brought to the company. And there was something really interesting going on in this company where the company owns 40 hotels. But in addition to that, they had a JV where they had a minority interest in another portfolio of hotels. And unfortunately, that JV was totally underwater. That other portfolio of hotels had debt, that was way more than the value of those hotels in the JV portfolio. And there was one analyst from Stifel who was basically modeling Chatham Lodging Trust completely wrong, because he was basically taking the debt from the JV, which was totally non-recourse to Chatham. It was crystal clear that it was non-recourse, but he was deducting that debt from the price target for Chatham. And the way the math worked, it was really significant. The stock was $5 a share. He had an $8 price target, so his price target was still 60% higher than where the stock was. But if he was treating the JV debt correctly and calculating his price target the same way, his price target would have been $13 a share. So it was really significant. And again, this was the smallest company he covered. I'm pretty sure he wasn't really paying any attention to it. So anyway, I formed a good relationship with Chatham's management team, and I told the CFO, here's what's happening. Like, look, here's the Stifel report. Here's where he's wrong. He's deducting this debt, which is clearly non-recourse. And so on the company's next earnings call, they put a slide up on their earnings presentation, and they spent a few minutes on the earnings call talking through the debt structure and how the JV debt was totally non-recourse to the company. And, lo and behold, when the Stifel analyst put out his next report, he updated his methodology that he was using to calculate the target price. And so I feel like that's a perfect example of, the kind of companies that I play in and the kind of value that I can add as a constructive, engaged shareholder to these companies. And I bought that stock around $5 a share. It's currently around $13 a share, less than a year and a half later. And I think it probably will eventually go back to 20 where it was pre-pandemic as the virus continues to recede. So it's already been a great investment for me.
Well, thanks, Sean. That's a cool story and a really helpful example. Now, you've had great results so far, but what about the future? Can you talk about the outlook of your strategy now?
Yeah, look, I think the outlook for my fund is great. Like I said, I only need to find a few new stocks each year to make the strategy work. I always think I can do that in the small and mid cap universe. And, related to that point, I'm buying a new stock right now, even though the market is hitting all-time highs. I'm buying a new stock right now that is a $600 million market cap company. I think it's under everyone's radar, and I literally think it could triple or quadruple in the next few years. And so, I always think I can find those kinds of opportunities. And so I'm really excited about the fund. But that does kind of raise the point that I do have to keep the capacity of the fund limited. It's open now, but I can't grow it forever and continue to take advantage of those size opportunities, which is what I want to be able to do to compound at the highest rate I can. And the other point I would say about the outlook is, private equity appetite and cash on the sidelines is really a positive thing for me and my strategy, because the kinds of companies I buy, are perfect kind of bite-sized acquisitions for private equity. Earlier in 2021, I already had one of my companies get taken out by private equity, and I'd be surprised if that doesn't happen again over time.
Well, that's terrific. But Sean, before I let you go now, I have to ask, why did you choose the name Honest Capital?
Oh, well, I just noticed that that was something people consistently told me throughout my life. That, hey, look, Sean, you're very honest. And, for better or worse, it's not always a good thing. But, I can't help it. I will always give you my honest opinion. And so I thought it was a fitting name for the fund. And also from a shareholder engagement perspective, it makes a lot of sense. If I invest in a company, I'm going to give them my honest opinion for better or worse, whether they like it or not. And I also think it fits well with the transparency point that I mentioned earlier. My LPs, I'm an open book. They know all my positions and why I own them. And again, people really like that.
Well, that makes a lot of sense. Sean, it has been wonderful to meet you today. Thank you so much for your time.
Oh yeah, absolutely. Thank you so much. This was a lot of fun. Really, really enjoyed it, and thanks again for having me.